Hi, and welcome back to another episode of CFI Deeper Dives. Past month of March has been an absolutely wild one. First, we saw Silicon Valley Bank, SVB, fall apart, and shortly on the heels of that, we saw UBS buy out its beleaguered rival, Credit Suisse, in what feels like one of the most dramatic moments in global banking since the global financial crisis of 2007 and 8. My name is Mian, and if you've tuned in the past, you might have seen me here before. I'm the director of our financial planning and wealth management program here at CFI. And today, I just wanted to take a few minutes to talk to you about Credit Suisse and the end of Credit Suisse as we've known it. So I'll give you a few background informational points about the bank itself, then walk you through a timeline of key events that led to Credit Suisse being sold to UBS, and then I wanted to touch on how UBS and the new UBS is set up in a strategically important position to change the landscape of one of the fastest growing areas in finance today. So to set the scene for you, if you follow global markets, you're likely going to be familiar with the fact that Credit Suisse has largely been the ugly duckling, or rather problem child, of European banks for quite some time. And why is that? Well, here are some of the headlines that they often make in no particular order. First headline: Credit Suisse is found criminally guilty and fined for their involvement in money laundering related to a Bulgarian drug ring. Next headline: Credit Suisse pleads guilty to wire fraud and is ordered to pay $22.6 million in restitution to investors who were defrauded when they purchased debt that was supposed to help finance a tuna fishing project in Mozambique. Next headline: Their chairman of global banking had to resign after publicly breaching COVID lockdown rules. Next headline: One of their former CEOs had to resign and step down after a corporate espionage, i.e. spying scandal. And then overall, there's just this willingness to take on clients that basically every other bank has avoided, like disgraced financier Lex Greensill, or failed New York-based investment firm Archegos Capital Management. There's also always headlines about management restructuring plans, and there was that massive leak of client data. And this is just a short list of the headlines they've made, and it's not an exaggeration to say that they've been involved in almost every single scandal of the last decade and lost money in every single one of those situations. So now that you know a little bit more about Credit Suisse, I want to talk to you about the timeline of key events that led to that proverbial nosedive, so to speak. So on March 8th, Credit Suisse had to delay publishing its annual statements because they received a call from the US SEC the night before the report was due with questions regarding revisions made to the 2019 and 2020 cash flow statements, as well as related controls. March 14th. Fast forward several sleepless nights and exhausted analysts later, Credit Suisse was finally able to publish their annual statements. But in them, they admitted that there were, quote, material weaknesses in financial controls, and also stated that they would be ending board bonuses. It's not a good sign. Now, in an unfortunate coincidence of timing, if you were following the news and the news about SVB in particular, you'll know that these announcements made by Credit Suisse just happened to fall right after SVB had fallen apart. Now, that's a time when markets were already very fragile and trying to understand the failure of community banks like SVB and Signature. Now, trust and confidence are incredibly fragile and equally important pillars of banking infrastructure, and they were already wobbly at best prior to Credit Suisse making their announcements. And so naturally, the events that followed were plummeting stock prices, ballooning CDS spreads, and clients withdrawing funds from their private wealth management division at a rate of, at one point, $10 billion a day. March 15th, the day after the announcement. Now, this is a day where things went from bad to worse, and they did so very quickly. So a Bloomberg TV correspondent happened to be interviewing the Saudi National Bank chairman, who also happens to be the largest single shareholder of Credit Suisse. He asked him that if Credit Suisse needed additional funding, would he consider? And his response, the chairman's response, was very quick and curt. He said absolutely not. And for markets and anyone and everyone that was watching, it was absolutely a problem. Now, had he phrased this in any less of a harsh way, it probably wouldn't have triggered the panic sale that it did, but it did, and ultimately, Credit Suisse's stock plummeted nearly 25% by the end of the trading day. Now, the day after and in the days after, things start to quickly spiral out of control for Credit Suisse, with clients withdrawing funds very quickly and picking up pace by the week's end. Also, international banks have either cut ties altogether or stopped doing business with Credit Suisse. And this is when the regulator stops and says, if this continues at the pace it does, the bank will probably not open on Monday. Now, the end result. Ultimately, Credit Suisse, as we know, was bought by UBS for $3.2 billion in an all-stock deal. This meant that shareholders were paid in the form of UBS shares as opposed to being paid in cash. And now this represented a huge discount to the firm's prior market value. So the anatomy of this deal was curated by the Swiss government. And the Swiss government additionally guaranteed that just under $10 billion would be guaranteed for the joint entities' losses that they might incur on certain portfolios and assets with this deal. And now, controversially, Swiss regulator FINMA demanded that $17.3 billion of Credit Suisse's additional Tier 1 AT1 bonds be written off. Now, this is very controversial because it means that debt holders did worse than stockholders. To do this, they needed to introduce emergency legislation that stripped the shareholders of Credit Suisse and UBS to vote on the deal, because we know what they would do, which, as you can imagine, was not well received and is still not well received. Now, a merger like this has been discussed previously. It's not a new idea that was tabled yesterday. So it wasn't the first time that people heard about it, but there were always antitrust issues that were an ongoing concern, and having these two globally systemically important banks merge to become one to create an even bigger bank was not one that was well received. Now, if there is one line of business in particular that is huge at both of these banks coincidentally, it is wealth management. Now, Credit Suisse and UBS are always within the top 5 players of wealth management globally. Now, this is in terms of assets under management. But now that the two have become one, they are this giant behemoth in wealth management. And that itself is a huge risk that wasn't there before. Now, prior to UBS buying Credit Suisse, UBS was already a top player in the wealth management game. By assets under management, they were always in the top 3 every year. And now, with Credit Suisse's clients, they are the clear leader of the pack. But it also doesn't mean that this transaction will have Credit Suisse's clients integrate seamlessly into their operation. In fact, S&P has revised its outlook on UBS to negative on integration risk. This type of event offers Morgan Stanley, B of A, and other Swiss competitors to poach talent and invest in one of the highest growth sectors in finance. With headlines like this, we'll definitely want to keep tabs on UBS and see how things shake up for them during the year.